Hello everyone, we are from Group 2. Today we will be presenting our report entitled Stock Market Performance and Capital Market Stability in Malaysia During Crisis. First, let's look at the introduction part. This presentation focuses on stock market performance and capital market stability in Malaysia during periods of economic crisis. Financial markets play a vital role in supporting investment, business growth, and economic development. However, during crises such as the COVID-19 pandemic, markets often experience sharp declines and high volatility. By examining market behavior during these periods, we can better understand how crises affect investors' confidence and economic stability. During an economic crisis, investor confidence usually falls due to uncertainty about the future of businesses and the economy. Many investors rush to sell their shares, which leads to panic selling and a sharp decline in share prices. As a result, the stock market becomes highly volatile and financially unstable. The stock market is a place where investors buy and sell shares of companies. In Malaysia, this mainly takes place in Bursa Malaysia, where many major companies such as banks, energy firms, and manufacturing companies are listed. Stock market performance is commonly measured using indices like the FISC Bursa Malaysia KLCI, which shows whether share prices are rising or falling over time. Capital market is broader than the stock market. It includes both stock and bond markets that help raise long-term funds for investment. Through the capital market, companies can finance expansion projects while the government can fund infrastructure and development programs. A strong capital market is essential for economic growth and financial stability. Stock market performance and capital market stability are closely linked to Malaysia's overall economic health. When markets perform well, businesses can raise funds easily, investment increases, and also employment opportunities expand. Investors' confidence also improves. However, when markets decline during crisis, wealth is lost, investment slows down, and also economic recovery becomes more challenging. That is all for the part introduction. To better understand the impact of crisis on financial markets, the next sections will examine Malaysia's stock market performance and capital market stability during major economic shocks, particularly the COVID-19 pandemic. This includes analyzing changes in stock indices, market capitalization, and the role of policy interventions in supporting the market recovery.
Stock market performance in Malaysia during economic crisis. In this video, we will explore how Malaysia's stock market performed during economic crisis, focusing on change in market volatility and investor reaction during uncertain times. Have you ever heard people say the stock market fell because of COVID-19, Shifa? Yeah, but what actually caused the market to react like that? During COVID-19, Malaysia experienced an economic crisis. An economic crisis happens when economic activities are suddenly disrupted, business close, income falls, and uncertainty increase. That's explain why everyone felt so uncertainty at that time. Exactly, Shifa. When uncertainty rises, investors start to worry about the future. They ask questions like, can company survive or will I lose my money? And that fear affect their decision? Yes, many investors react emotionally, which leads to panic behavior in the stock market. But how do we actually see the impact of a crisis on the stock market? We look at stock market volatility. Volatility measures how unstable or unpredictable stock prices are. Higher volatility means higher risk and uncertainty. Before the crisis, Malaysia's stock market volatility was relatively low. In 2018, it was about 7.79, and in 2019 it increased slightly to 9.82, showing fairly stable market condition. So, what happened when COVID-19 started? When COVID-19 hit in 2020, volatility rose sharply to 30.96. This reflects strong investor fear, uncertainty, and unstable market performance during the crisis period. Did the market recover after that? Not fully. In 2021, volatility increased further to 60.13, which suggests that although recovery if effort began, investor confidence remained fragile. So, what can we conclude from this? Economic crises like COVID-19 significantly weaken stock market performance. Rising volatility reflects fear, uncertainty, and panic behavior among investors, showing how sensitive the stock market is to economic shocks.
In Chapter 3, this part focuses on understanding market behavior during crisis, especially how emotions such as fear and uncertainty influence investor decisions. During market crashes, investors often panic and make emotional decisions. In the next slide, I will explain the main reason behind this behavior. During a crisis, bad news spread very quickly through the media and social networks. This causes fear among investors, especially the fear of losing money. When investors are unsure about what will happen next, they start making emotional decisions instead of rational ones. When fear increases, investors begin to sell their shares quickly. This is called panic selling. They are afraid price will fall further, so they sell to avoid bigger losses. At the same time, many investors follow what others are doing. This is known as herd behavior. Instead of analyze the market carefully, they copy the crowd action. When investors make emotional decisions, price fall faster and the market becomes unstable. This causes crashes to become more severe. Overall, investor behavior plays a major role in worsening market crises.
Now let's look at capital market stability and how Malaysia's market responded during a crisis.
What is capital market stability?
Capital market stability refers to the ability of the financial market to remain strong and functional even during economic shocks.
How do we measure market stability?
One important indicator of capital market stability is market capitalization, which is the total value of all listed companies' shares in the stock market.
Why market capitalization matters?
It is because when market capitalization is high, it shows strong investor confidence and indicates a stable and healthy capital market.
What happens during a crisis?
During economic crises such as COVID-19, fear and uncertainty cause investors to sell shares, leading to falling share prices. This graph shows Malaysia's market capitalization before, during, and after the COVID-19 crisis. We can see a sharp decline in 2020 as share prices fell due to investor panic. After the crisis, market capitalization gradually increased, showing that investor confidence began to return.
What does the drop mean?
Sharp drop in market capitalization indicates reduced investor confidence and weaker capital market stability. The gradually recovery in market capitalization shows the Malaysia's capital market is resilient and capable of stabilizing after a major crisis. Overall, market capitalization helps us understand how stable and resilient the capital market is during period of economic uncertainty.
Chapter 5: Policy Intervention and Capital Market Stabilization.
Neela, why does the government step in during a crisis?
During a crisis, stock market don't fall just because companies are bad. They fall because people panic. Investors rush to sell, prices drop sharply, and confidence disappears. So the big question is, who steps in when the market is unstable? In Malaysia, that role is played by Bank Negara Malaysia, our central bank.
So, what is Bank Negara Malaysia?
Bank Negara Malaysia or BNM is responsible for keeping Malaysia's economy and financial system stable. When the stock market is unstable, BNM does not buy shares directly. Instead, it uses powerful tools that influence our money flows in the economy.
What is OPR?
One of BNM's most important tools is called the overnight policy rate or OPR. In simple terms, OPR is the interest rate that affects how expensive or cheap it is to borrow money in Malaysia. When OPR is high, loans are expensive. When OPR is low, borrowing becomes cheaper.
How do we know OPR matters?
We know OPR matters because we can clearly see what happened during the COVID-19 crisis. As the economy slowed and market crashed, Bank Negara Malaysia cut the OPR several times. This wasn't a coincidence, it was a deliberate move to support the economy and calm financial markets. This graph shows Malaysia's OPR from 2016 to 2025. Notice how the interest rate dropped significantly in 2020, right when COVID-19 hit. This tells us that BNM actively used monetary policy to respond to the crisis.
Why does lower OPR help the stock market?
Lower interest rates help the stock market in several ways. First, businesses can borrow money at lower cost, allowing them to continue operating and investing. Second, when bank interest rates are low, investors earn less from fixed deposit. So they look for better returns in the stock market. This increases demand for shares and helps stabilize market prices.
So what's the result?
By lowering the OPR, Bank Negara Malaysia helps restore confidence among investors. When confidence returns, panic selling reduces, market volatility declines, and capital market stability improves. This shows how policy intervention plays a critical role during economic crisis.
In conclusion, Malaysia's experience during economic crisis shows that stock market performance is strongly affected by fear, uncertainty, and investor reactions. During events such as the COVID-19 crisis, panic selling led to sharp declines in share prices and market capitalization, even when long-term economic fundamentals remain intact. This highlights how market behavior during crisis is often driven by emotions rather than national decision making. At the same time, the stability of the capital market plays a crucial role in supporting economic recovery. Market capitalization reflects investor confidence and its decline signals reduce economic activity. Policy interventions, particularly through Bank Negara Malaysia's adjustments to the overnight policy rate, help stabilize financial markets by improving liquidity and restoring confidence. Overall, this study shows that while crises cannot be avoided, strong policy response, market stability, and long-term investment perspectives are essential for sustaining Malaysia's economic growth.